1992. That's the last time the Federal Reserve was this divided. This just happened, and most investors don't realize what it means yet. Here's what's really going on and what you should be thinking about right now. The Fed just held rates steady, but the vote wasn't clean, not even close. Internal dissent at the Fed has hit its highest level since 1992. That's not a footnote, that's a 5-alarm fire inside the central bank. Inflation is sticking, and sticky inflation changes everything. Rate cuts? Forget it. A rate hike is now back on the table, and markets are pricing that reality in right now. Growth stocks are taking hits. Higher rates compress future earnings valuations. If you're holding high multiple tech names, you are feeling this today. Bond prices move inverse to rates. Every basis point higher on that Fed funds rate means more pain in your fixed income portfolio. Duration risk is not theoretical right now. It is live. Retail investors are caught in a double bind. Higher borrowing costs and renewed pressure on equity valuations simultaneously. That is a brutal combination. The Fed held, but the dissent tells you the debate inside that room is fierce. When central bankers can't agree, markets don't get clarity, and markets hate uncertainty. But here's what nobody is saying about this yet. The 1992 comparison isn't just dramatic, it's a roadmap. The last time dissent reached these levels, the Fed pivoted harder and faster than anyone expected. Both directions. The division you're seeing today means the next move is binary, and the timing is completely unpredictable. That unpredictability is the risk, not just the rate level itself. First, audit your duration exposure immediately. Long-duration bonds are the most vulnerable instrument in a rising rate environment. Short-duration fixed income reduces that exposure significantly. Second, consider rotating toward defensive positioning. Sectors like consumer staples and utilities historically demonstrate greater resilience when rate hike fears spike. This isn't about panic, it's about asymmetric risk management. Third, reassess your growth stock allocation. High price-to-earnings multiples compress when the discount rate rises. If your portfolio is overweight growth, now is the time to pressure test those positions against a higher rate scenario. The Fed is divided, inflation is stubborn, and a rate hike nobody wanted is suddenly the conversation dominating Wall Street. What do you think this means for your portfolio? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.